Stocks may be rallying after that half-point rate cut, but my next guest says following this Fed is like following a car swerving all over the road. Makes you want to slow down and even get cautious. Joining me now is Charlie Bobrinskoy, Vice Chair and Head of Investment Group at Ariel Investments. So glad to get your thoughts, Charlie, on everything that's taken place. I don't know if you caught the segment with Barry Knapp earlier. He's been quite bearish, but after this cut is feeling more positive about things. Sounds like you might disagree.
Yeah, and this is a complicated topic and not easy to do quickly, but just the basic idea is that Milton Friedman at the University of Chicago wrote a wonderful book called The Monetary History of the United States. And what he proved was that what we needed was slow and steady monetary policy, where the Fed would raise the money supply at a predictable rate of roughly 5 to 6%, which would allow for growth but not cause inflation. The reason he said that is because the Fed tends to look back at history and is slow to adjust its policy, and then the effects of monetary changes are variable and lagged. They tend to not show up for 9 to 18 months. And so the effect of a change in policy often would have been helpful in the past, but ends up exacerbating the problem going forward.
Of course.
So what do we have here? We had the Fed flood the market with cash during COVID, taking the money supply from 15 trillion to 21 trillion, the biggest increase we've ever had. That caused inflation just as the economy was recovering. Then they slam on the brakes and take up interest rates up faster than the Fed has ever taken up after inflation was actually coming down. And now they've been slow to adjust their interest rates to what is clearly a weakening job market. And now they see that, and now they're going to over adjust again. So what would be better is if they would act in a Ariel slow and steady way and be much more predictable instead of veering all over the road, which just makes everybody more cautious.
I think you're quite right, and this itself is controversial. There are people, yesterday I believe Claudia Sahm was talking about this. I've heard at Lazard, Peter Orszag say the same thing, that this wasn't monetary, that it was supply chain predominantly. And so even as you say, they took these actions with the monetary base, if they did something too aggressive in the first place, shouldn't they be aggressive in taking it back to make sure that we get kind of back towards that's Barry's argument, is get back to 4% as quickly as you can.
Right. But Kelly, if you look at the monetary numbers, they went from 15 trillion in M2 to 21 trillion. Over the last year, we've actually had 1 year decline in the money supply. We've never had a decline in the money supply before. They've already started to try to take that excess liquidity out of the market. They've succeeded in bringing inflation down. And now they've had interest rates way above the natural rate. And another thing for listeners to watch is that the natural interest rate is 1 to 1.5% above the inflation rate. So the real interest rate should be 1 to 1.5%. In the world we're in today, that should mean something like 3.5 to 4%, not this crazy 5 to 5.5. So they were very slow.
That's the argument for cutting by 50, and you're making the argument.
No, I'm saying they've been wrong. On your show and others, many of us have been calling for them to begin the process of cutting rates.
Yes.
But they should do it in a much more modest 25 basis points
All right.
a quarter. So yes, so fine. So now they're going to admit they were wrong and speed up and go too quickly, and watch. They'll go too fast the other direction, just like that drunk going down the road.
The only way it could be too fast is if you think the economy is actually okay. And look at jobless claims this morning. They were good. And that we start to get a resurgence of inflation.
That's exactly right. So this is very important. The job market has been softening, but it's actually going to be okay. And we have built up demand for housing. We have built up demand for cars. The economy is going to be fine. The threat that we're actually going to see, and this is the first time I've said it, Kelly, but it is true, is we have two new administrations potentially running for president. Both of them are going to increase spending. We are going to have bigger deficits. We are going to have tariffs. We are going to have less globalization. All of those things longer term are threats for more inflation, not starting right away. But if you look out to 2026, big deficits, tariffs, end of globalization, we're going to have a lot of pressure on inflation.